not be so relevant, right, to bio-nexus status companies. So I've decided that this public ruling on bio-nexus status, I'll put it in at the last, right? At last, yeah, I'll cover the rest first. Then only we go into this public ruling. That means we'll start off with public ruling number 2 on the tax treatment of stock in trade. There are 2 parts, yeah. Public ruling number 2 and 3 are both talking about stock in trade and what is the tax treatment. Because this first part talks about valuation and the second part talks about withdrawal. Okay, and of course, the 4th public ruling that was issued in year 2020 talks about any sum received or any debt owing to someone arises in respect of services to be rendered. This is a very important update, right? I know a lot of you may have already know about this, but today I'm going to go in depth and tell you more, like what is the tax treatment if you receive any money for a service to be rendered in the future. That means the service is not rendered yet, it's going to be rendered in future, but you have already received some money or you're owing someone some money already. So what will happen? Yeah, so this is public ruling number 4. Then we move to this capital allowance, right? We move to practice notes, also income tax related, yeah, these 2, yeah. Practice note number 2 talks about capital allowance on customized computer software. And of course, practice note number 3, this is very important. Let me repeat, practice note number 3 is very important, okay? You must all right, pay attention to this because this one talks about determination of the 50 million gross income. You may say, why is it so important? Because this is going to change some of your tax treatment for some of your companies, right? This is relating to the SME status, yeah, of which you enjoy the 17% preferential tax rate, right? So please pay attention when I talk about this practice note number 3, yeah. Then we move to service tax, right? There's some amendments in service tax policy number 9, 2020, and we will talk more about what happened to the latest GST refund. What are the updates? Okay, so these are the things that we're going to cover. So of course, like I said, the first public ruling, I will skip for now. I will push this to the back. We'll start off with public ruling number 2, right? Because this bio-nexus company, I think most of you may not, right, may not be, how you call that, this may not be applicable to you, right? So I will start off with public ruling number 2. Okay, so let's go into public ruling number 2. And let me see, the chat was flashing. Okay, Sutasan was saying good evening. Hi, Sutasan, good evening to you. Okay, now let's start off. Public ruling number 2 talks about stock, okay, tax treatment of stock in trade. Now, those who do trading and those who do trading, manufacturing, you definitely would know that you have stock, right? You have opening stock, you have your WIP, work in progress, then you have your closing stock, right? So what is the tax treatment of stock when it comes to valuation, right? This is very important because when we talk about tax treatment, we need to look at the value of the stock to see how it affects your tax treatment. So in this public ruling, it talks about how do you value your stock? How do you value your stock when you have stock in your business? Okay, so it says, first of all, what is stock in trade? Any business that has to acquire producers or manufacturers, right? Or for the purpose of manufacturing, selling something as inventory, that is called stock in trade. So when you need to manufacture or you have to acquire something and you need to resell them, right, to exchange for profit, that thing is actually called stock in trade, right? In other words, inventory. Now, but what is the value of stock in trade? Now, to determine the value of stock in trade, they say this value of stock in trade is important because it is to determine your adjusted income in accordance to Section 35. And Section 35 says the value of stock should be the lower of either the market value or your cost. Now, which I will explain later also in this public ruling. In this public ruling later, it will talk about the definition of this value of stock in according to Section 35, right? And the meaning of stock in trade is also explained in this public ruling, of which it says anything that is being used, right, whether it's movable or immovable, right, and materials that are being used in the ordinary course of business, be asset, be it stock being manufactured, or whether it's land or building, even shares, sometimes shares or marketable securities, this could be stock, right? This could be stock, okay? So now the tax treatment here is simple. It says whenever you transfer the ownership of property, right, in goods from a seller to a purchaser, that is called the sale of stock already, right? That is called the sale of stock. And this is accordance to the Sale of Goods Act 1957. But now, when do we actually consider as transfer of ownership. When we say transfer of ownership of property, I know many of you would just say, oh, when I make a sale, when I issue an invoice, when I sell my stock to you, that's transfer of ownership. Yes, that is in layman term, right? We know that is the transfer of ownership. But there are a few conditions or scenarios that actually make transfer of ownership occurs. Now, what is that? Okay, you look at this one by one. First, when there is a contract for sale of goods. Now, this is the simplest one, right? This is the simplest one. When you sign a contract, right? When there is a contract, this contract has been signed, right? That means at the time where parties to contract intend it to be transferred. That means you want this stock to be transferred. That is called transferred, right? So the first one is very simple. But sometimes there's an unconditional contract. Now, you see, when there's an unconditional contract for the sale of specific goods in a deliverable state, right? What does it mean? It means when these goods are passed to the purchaser, right? When the contract is made. So sometimes when even the contract is unconditional, but the goods has been passed, right? Has been passed over to the other person, it means transfer. It means transfer of ownership already. And you have to understand the time of payment or the time of delivery is actually not very important, it's immaterial whether the time of payment or the time of delivery has been postponed or not. So you cannot just say that, oh, because my stock has been transferred, but the payment has not been made, therefore it doesn't mean transfer. No, same thing, even if the delivery has not been made, but when under an unconditional contract, the goods has been so-called passed to the purchaser in the deliverable state. That means it's also called transfer. In other words, the risk has been transferred. Once the risk has been transferred over, even though the time of delivery has been postponed, that is immaterial already. Okay, then a contract for sale of specific goods, and the seller is bound to do something to the goods, putting them in delivery state. Now, so this is when you have to deliver something, but you have to also do something. You've got to do something. You're bound, and the seller is bound to do something before the goods would be in a deliverable state. If that's the case, now the goods does not pass from seller to purchaser until the thing is done. Now, so if you say there's a condition, right, for you to transfer goods over, and if that condition is not fulfilled, right, that means the seller has to do something first. If the seller has not done that, even though the goods has been passed also, it is not transferred yet until this condition has been fulfilled, right? Sometimes you may have to perform something in order to let the whole goods being transferred over, right? So this is C. Now, D says the contract for sale of uncertain or future goods. Now, sometimes you may say, I have to transfer something in future, right? And the goods of that description in a deliverable state are unconditionally appropriated. Okay, that means if you say you need to pass something in future, right? Your contract is to say you are going to transfer goods in future, right? In a deliverable state, it only happens, the transfer only happens when the property in the goods immediately passes to the purchaser, right? So even if you say I have signed a contract, I'll be delivering something in future. As long as this thing has not been passed over, it's not transferred yet, right? So you cannot say once I sign a contract, but because I have not delivered something in future, and I call it the transfer, right? And the last one, E. Contract for the sale of specific goods in a deliverable state, right? It's deliverable state already, but the seller is also bound to do something, right? Some other act, right? Or things to the goods for the purpose of ascertaining the price. So without doing something, you can't get the price, right? So you have to finish that thing first, right? Until that act or the thing is done and the purchaser has been notified, then only there's a transfer. So I know it's a bit confusing over here, but this is just to tell you that whenever we talk about transfer of stock in trade, right, you don't just look at whether I have a sale or not, right? Because there are other conditions attached here. But of course, the most standard one would be if you send an invoice, you deliver your goods, right? They sign and accept your invoice, that means a sale already, right? That's usual, right? That's usual. But the important thing here is not about when is the stock being transferred. The important thing about this public ruling is on valuation. It's on valuation, right? Evaluation is the one that this public ruling wants to talk about. Okay, now basic rules to ascertain an adjusted income, right? From income tax, the very basic rule to know what is your adjusted income. That means what is the so-called business income, right? Business income that you are earning, right? From a year is that you take your gross income, you can minus off your deductible expenses, then you get your adjusted income, right? This is simple. But if we look in a bigger context with stock involved, this is what we usually look at. Now, this is what we usually look at. In 1 year of assessment, we usually will first look at what's your sales, right? Then you look at what is your opening stock in trade, right? Then you add on with purchases, okay? And if you have any production costs from manufacturing, if you're a manufacturer, we add this as well. Then we have to less the closing stock in trade, right? We less the closing stock in trade. With this, we will get cost of goods sold. Now, if you do accounts, you will know, this is simple, right? This is something very simple. Opening stock plus purchases plus cost of production for manufacturing minus your stock in trade, that means minus your closing stock, then you get cost of goods sold, right? So you take your sales minus cost of goods sold, you get gross profit, and minus of your deductible expenses, then you get adjusted income, right? So this is simple, yeah? So this is simple. Now, but the important thing here is on this one, the opening stock in trade, as well as the closing stock in trade. So in this public ruling, it says if the opening stock and the closing stock is different, it actually gives rise to different tax treatment, right? Because I think if you do accounts, you would know that, yeah, when your closing stock is high, right? When your closing stock is really greater than your opening stock, what will happen? Now, let's go back to this. If your closing stock is really high, even higher than your opening stock, you will see your cost of goods sold being very little, right? It will reduce your closing stock, and that means that your profit will be higher, right? Your profit will be higher because cost of goods sold is less. Sales minus cost of goods sold gets gross profit minus deductible expenses gets adjusted income. That means your net profit will be very high. So on the other hand, if your closing stock is very low, you have very, very little closing stock only, what will happen? Your cost of goods sold becomes very high, right? It becomes very high. That means your gross profit becomes low, your profit becomes low. So that is what this public ruling wants to talk about. So it says if your opening stock and your closing stock is different, right? You see, to ascertain your adjusted income, value of closing stock at the end of basis period, you have to compare it with your opening stock to see whether it goes towards higher profit or lower profit. See, if this closing stock exceeds the value of opening stock, like what I was saying earlier, closing stock is very high, right? Exceeding opening stock, then that difference, the difference will result in what, right? You see, the difference would be deducted against the total deductible expenses, resulting increase in adjusted income. Right? Because the higher your closing stock is, the more profit you have. So the more profit you have, the higher adjusted income it is. So on the other hand, is that if your closing stock is less, right? It's so much less, right? It's lower than your opening stock. Then what's the difference? The difference would be a deductible expense, right? It will be added into your deductible expense, and that will result in a decrease in adjusted income. That means lower profit. So lower lower closing stock, lower profit, right? So this one is basically very simple if you are doing accounting, right? If you do accounts, this is basic, okay? But the public ruling is for you to relook at it again in case you're not doing accounts, yeah? Now, so very simple. Now, valuation over here is, okay, value of opening stock, always be the value placed on the closing which has stock at the end of immediate preceding basis period. What does it mean? It means closing stock of last year equals to the opening stock of this year. That's simple, right? It means closing stock of last year would equal to the opening stock of this year, right? That is simple. But what is more important is this one right now. Value of closing stock. Now, this one is something you may really need to pay attention. Just now, remember, we were talking about Section 35. You see, the value of stock is in accordance with Section 35. What Section 35 of the Income Tax Act says is that value of closing stock, should be the market value or at cost, whichever is lower, right? So you have to understand market value and cost, right? You have to compare based on either cost or market value, whichever is lower. So what is market value? What is cost? Well, very simple. Market value means what is the price that you would fetch, right? That you can sell if it is dealing at arm's length price, right? That means that if you sell it to an independent party, non-related party, if you were to sell this stock to someone that is not related to you, what is the price that you can get? That is what we call market value. And of course, stock is simple. What is the cost that you have incurred when you acquire the stock? And always use first in, first out formula. Whatever that comes in first has to go out first. Or you use weighted average cost formula. So now, value of the stock in trade at the closing should use either of these. market value or at cost, whichever is lower. That's why sometimes you may see you can actually revalue your stock if you can determine that your stock is no longer worth so much. If you say, I cannot, there's no possibility for me to sell my stock at this price anymore, right? Because the whole market value has dropped, you can revalue your stock and then your closing stock will be lower. If your closing stock is at lower price, what will happen? Let's go back to the previous slide, if you still remember, If your closing stock is lower, what will happen? Decrease in adjusted income. You actually get to pay less tax on that because your adjusted income goes lower and your cost of goods sold becomes higher. All right. So this is something that you could do. Now, but what about work in progress? Those who do manufacturing, right? Those who do manufacturing, manufacturing, your WIP is like this. Okay. You can also use market value or your cost. Now, but market value can only be used if your WIP could be sold, right? Only if your WIP, even though not finished, it can be sold to a potential buyer, then only you have market value. If you're still manufacturing halfway, it's still work in progress and no one will buy this thing because it's not completed, don't use market value. You can't use market value because it's not something you can sell, right? Then you have to use your cost only. And your cost is your cost of raw materials or any other expenditures that you have incurred to bring these goods, these materials into these partly finished goods. All right. So again, WIP is also the same. Value must be either cost or market value, whichever is lower. But if there is no market for these uncompleted goods, don't use market value, right? Don't use market value. You can only value it at cost. Okay. Simple, So if you say, okay, I also deal with stocks. Stocks as in shares, all right, marketable securities or shares, right? Then this one, again, same basic principle, right? According to section 35, you use the market value or cost price, right? Whichever is lower. So this one, I'll probably say an example of if you trade shares, right? If you say I'm a share speculator, I always trade shares, I do share trading, okay? Every time if you do share trading at the end of the year when you do your profit and loss account, you can't use your cost, you can't use your cost to determine, right, what is the market value unless your cost is lower, right? Unless your cost is lower. But if you say the market value is lower at the end of the year, if you are a share trader, you have to use the market value if it's lower to look at what is the value of your closing stock. Okay, so this is for marketable security shares or stocks, okay. So now if you say, I am going to cease my business. Now, if you're going to cease your business, most of the time you say, okay, if I cease my business, there are two things that I will do. First, if I cease my business, I will sell off all my shares, right? I will just sell off everything. Second, I cease my business, just leave it, right? Just leave it there, or I'll probably just draw it and use it for my own, right? Now, what is the valuation of stock then if you cease your business, right? They are different, You look at the first one. If you say, when you cease your business, you're going to sell your stock, right? The stock of a business is sold or transferred to someone, either on cessation or shortly after cessation, then you would have to use the sale or value of consideration for the trading stock, not the market value, That means that if you're going to cease your business, if you're going to close off your business, you can find someone who will pay for you, right? Who pay a valuable consideration being paid, and they intend to use your stock, right, for their own business. Your valuation, when you sell your stock, you can just straight away use the sale price or the value of consideration. You don't have to strictly use the market value. That means you don't have to say, oh, the market value is worth 100, but because I have to close my business, I have to just, sell my stock at a very low price, just 30 ringgit instead of 100 ringgit, right? But because market value is 100, I still have to treat it as if I sell at 100. No, don't worry, right? You will be selling, if you sell at 30, the value is 30, right? The value is 30 because they use the sale price or value of consideration. Okay, of course, the cost of purchase or transferred stock is deductible, right, as an expense in the other person's business. So if the person really buys 30 ringgit from you, let's say, at such a low price, right, 30 ringgit is the deductible expense in the other person's account, right? You cannot also take the market value, right? You cannot say, oh, because the market value is 100, even though I pay 30, I'll treat my purchase price as 100. No way, right? Cannot, Now, but if you say you cease your business, and the above does not apply. That means you're not selling, right? You're not selling your goods away. You permanently cease, and this stock in trade remains unsold. Now, if it remains unsold, right, to value your remaining stock for whatever reason, right? Maybe you say you're going to sell off the whole business, or you just want to see what is the valuation of my business at that time, right? The remaining stock that is unsold and you're not transferring to anyone, you have to use the market value. you have to use the market value at the time of cessation, right? So you don't say, oh, cost or market value, whichever is lower. No, you only take the market value. So this happened only during cessation of business. Okay, so that is the first public ruling that talks about valuation of stock. Okay, valuation of stock. But what is more important is actually the second public ruling that we're going to talk about, right? That is withdrawal of stock, right? Withdrawal of stock. Now, I know some of you who does business, yeah, you probably would do this from time to time, right? I'm selling, say, stationery, right? I'm selling stationery. Then my kids say, right? My kids say, hey, I need some stationery for me to do homework. I need to do my homework and then to bring to school. They say, I have some stationery over there. Just go and take whatever you want, right? Just take your stationery and then just bring it to school and use it, right? Some of you may do that, right? Some of you may do that. Now, if you do that, what happens, right? What is the tax treatment when it comes to withdrawal of stock? That is explained in this part 2 of this public ruling. Now, this part 2 of the public ruling becomes very important because if you withdraw any stock, right? If you withdraw any stock in trade for own use, it has to be treated as deemed sold. Remember, yeah? If you withdraw any stock for own use, you may say, I did not sell it, I don't receive any money, I have no invoice, but it has to be accounted for as if the item of stock in trade had been sold, okay? Because you see what happened, if you say I withdraw stock and I don't bother anything, my closing stock would be lower, right? And if my closing stock is lower, my cost of sale becomes higher and I pay less tax, right? Because my profit is lower, my income is lower. That is not supposed to be the case, right? You didn't lose the stock. You take the stock and you use it for your own. That's why if you withdraw the stock for your own use, you have to account it as if you have sold it, and you have to do it at market value. I know some people will say, okay, I treat it as if I sell it, but I sell it at a low price, I sell it at a discounted price. Cannot, it must be at market value. What is the price that you will sell to an independent person? You take that in and you actually have to treat it as if being sold. Okay, so that is how it is supposed to work. I know you will say, it doesn't mean that I have to issue an invoice issue to myself then because I withdraw the stock. Well, if you want to do that, that's okay. If you want to, just issue invoice to yourself and treat it as if you buy the stock. But even if you don't do that, right, when it comes to doing income tax, any withdrawal of stock, you will have to determine what's the market value of the stock that you have withdrawn, and that will be added into your gross income for that basis period, right? So this is according to Section 24, yeah, of the Income Tax Act. Okay, so now, when you withdraw stock, right, there will be different scenarios over here. First is you withdraw stock, you use it for some other activities, right? Either you withdraw stock, say from business A, you put it into business B, or you withdraw it for your own use, like the example that I've given, right? You take stock and then you give it to your children, right, for them to use the stationery for their own homework, let's say, right? So it's the same thing. If you withdraw your stock from business A and it goes to another activity, either business B or another activity, then you treat it as if you have sold the stock, right? You have sold the stock and you have to treat it as if business B has purchased the stock also at market value, yeah. But sometimes another way of withdrawal could be change of intention. Change of intention means reclassification. That means, yeah, your stock in trade, before this it was stock in trade, but then later you find that, hey, I don't intend to sell this stock anymore. I want to use it for my own. I want to treat it as my own capital, my fixed asset, right? Example, if you're a property developer, let's say, you would build a lot of, shop lots, a lot of shop lots. You initially wanted to sell those shops after you have constructed them, right? These are your stock in trade, where you want to sell the shops. But later you say, hey, one of these shops, it looks really good and I need the shop. I need the shop to run my own business. So I changed it to my fixed asset, right? Instead of stock in trade, I reclassified it and I put it under my PPE, under my property, plant and equipment, and it becomes my fixed asset. If that is the case, this is also called withdrawal. Yeah, this is also called withdrawal, even though you did not actually withdraw it and put it into another business or give it to someone else, right? But this is also called withdrawal. And if you do that, what will happen? Now, if the stock reclassified from trading to capital, like the example I was saying, a developer takes a shop lot which initially he intends to sell, he now transfer it to my fixed asset. Yeah, I would have to treat it as I have sold it. I have to treat it as if I have sold it, yeah, at market value. It becomes a business income to me. It means I have sold my stock, my shop, and I sell it to myself. I sell it to myself, I buy the shop again, and I use it for my fixed asset. Now, if it is the other way around, if I reclassified it from capital to trading, right? So let's say initially, when I build my shops, right, I do reserve some shops which I say it is for myself. So I already classified it as capital. But later, I say, hey, I think I really want to sell, like, I don't really need this anymore. So I put it back into the stock in trade. I want to sell them. If you put it back into your stock in trade, again, it is called deemed sold as well. But then you pay RPGT, right? You pay RPGT because you are actually selling something that is of capital in nature already, right? So you got to pay real property gains tax. And then this selling price goes into your purchase of stock in trade. Yeah, so it goes back to your stock in trade. So this is what happened when you withdraw stock from one business to another business, or you change the intention. Okay, so now if you withdraw stock for any other reason, right? If you withdraw for any other reasons, right, without consideration received, or if you have to receive certain consideration, but it's a mixture, you get certain considerations, and you don't get the full consideration, right? You get something else, right? You get something else, right? Then again, this withdrawal of stock in trade would have to use a market value as well, and it has to go into your gross income as a gross income. Now, let me show you an example. Let me show you one example that is being shown in this public ruling to explain further what do you mean by withdrawal of stock in trade for other reasons, and how do we look at what's the market value, how much do you receive if it's not in full, and then what happened next. Okay, now look at this example. Boone. Okay, Boone operates Boone Mart as a sole proprietor. Okay, so he's a sole proprietor, but then he withdraw his stock in trade, right? He withdraw his stock in trade from his business, right, which has a market value of 3,000. That means if he were to sell this stock, he would sell it at 3,000. But he withdraws it, right? He withdraws it, right, on the 1st of June to be given to his neighbor. So he wants to give it to his neighbor. But even though he said he gives it to his neighbor, it doesn't mean that he gives it totally free, right? This withdrawal of stock has created some debt. All right. So after he withdraw it, he gave it to his neighbor, right? He said, okay, the neighbor would then owe him 1,000, and then he also received some money, right? He received 1,500. But the fact here is, because this is not a sale, now because this is not a real sale, that means he doesn't actually issue a receipt or invoice and sell it to the neighbor. He actually withdraw it. He gave it to the neighbor. And because after giving to a neighbor, right, it created a debt. You say, okay, the neighbor still owes me 1,000, and then somehow there's a cash of 1,500 ringgit also given to him, right? Maybe by the neighbor, maybe by someone else, yeah? What would happen here is this 3,000 market value would still be the income, but it's separated into a few different sections of the Income Tax Act when we say this 3,000 is your income. Because when you take away a 3,000 ringgit worth of stock, right? You have a trade debt of 1,000. According to Section 24, right, Sub 1, it says when you have a trade debt arising from disposal or transfer of stock, this trade debt becomes a sale, becomes an income to you. So this trade debt, 1,000 is your income. If you receive cash, straightforward. Section 28 says you receive cash, yes, that's your income already. But even though you only have this 2,500 in total, this 500 balance over here, yeah, this is because a withdrawal has happened. According to Section 24 sub 2, this 500 ringgit is still considered as your income because you withdraw it and you give it away, right? So what is the moral behind the story? Now, if you're smart, if you have seen this, you probably would have said, hey, then I might as well issue an invoice, sell it to my neighbor, he pays me 1,500 and he still owe me 1,000. Isn't that even better? Well, if you do it in a proper way, then it's not this scenario anymore, then it becomes you're selling your stock at 2,500. So you got to be very careful. If you really want to sell, make it a proper sale. Have your invoice ready. Don't just withdraw and then just say, oh, he owes me money, right? Then I have some cash. If you withdraw, then only you go and do some other things, right? You have to use market value. And that means even the balance of 500 is still a gross income as per Section 24 too. Okay, so hope you get this part, yeah? All right, but sometimes you may also have this scenario where you have to sell or transfer your stock, right, compulsorily, right? Because, like, very simple example, like say you are a developer again, right? Simple, right? Property developer, right? You have certain properties that you have developed, right? That you have constructed. Then government says, I need to take over. I need to buy all of them from you. I need to take over the land, so I need to buy all your properties over from you. You didn't want to sell, but by compulsion, right? Compulsory acquisition happened. They come, they take your stock. Now, you may say, hey, this is compensation. This is not a sale of stock, isn't it? No, it is still under Section 4C, 4 capital C. Any amount receivable arising from stock in trade treated as gross income, right? Still your gross income, if the stock in trade is parted by way of compulsory acquisition. So with effect from year 2014, if whether it is movable or immovable goods, by compulsion, right, you have to sell off the stock in trade and you receive certain money, that is still considered as your gross income, right? That is still your gross income, and that goes towards your business income as well, right? So this is what Rapid Billing wants to talk about. All right, so I suppose up to here you are pretty clear because I see no questions at all. Hey, someone asked me a question already. Just about to ask if everyone is clear. Someone asked me this question. Mega Fortress asked me, where we cease the operation and transfer our stock to someone with zero value as free, we record as write-off inventory based on cost and show gross loss can. Oh, okay. Now, Mega Fortress, if Mega Fortress Lee, okay. Now, if you transfer your stock for free, okay, are you transferring to a related party or non-related party? Now, I'll put it this way, if you really transfer to a non-related party and you have a proper agreement and say he doesn't have to pay you, he can just take it off for free, you treat it as a sale, because that's why I was saying that when you cease your business, all right, let me go back to here. When you cease your business, okay, you would only take the contract price, right, the valuable consideration, not the market value, if you were to sell it, right, to someone who is actually independent. But if you sell it or you transfer it to someone that is not independent, related, then the IRB would always come in and use the anti-avoidance rule and say, no, you are purposely doing it, right, and giving it away for free, right? So you probably need to also use the market value. But if you say, I would say, put it this way, why don't, right, instead of giving it for free, put a very nominal value, right, a nominal value, and sell it to the person, right? That will be even better, okay? So you said we record as write-off inventory. Yeah, well, it's not really a write-off. I mean, if you give it for free, then it's write-off, but if it's a sale, then yes, you still have a sale. Even if you sell it at a very low price, you still get a gross loss, right? You still get a gross loss. Okay, Santi asked, how about if the stock item is given out as sample? Or if the stock is given out as sample, what's your question, Santi? Are you trying to say what is the value, is it? Are you trying to say what is the value of the sample, is it? Now, because if you say the sample is something that you purchase, then the value is your purchase price, right? And you can always give out sample. If it's your manufactured goods, then just use your cost of your manufactured goods, right? Then yeah, that's it. So I don't really get, Santi, what's your question? So I think if you're asking about what's the valuation, you can just use your cost, okay? All right, because sample is not something that you sell, so you don't get a market price, you don't get a market value as well, right? Okay, Jess Lee asks, what's the double entry for transfer stock? Value 100, market value 150 to fixed asset. Oh, so you transfer your stock, that is, okay, right, but what I said earlier, if you transfer your stock from stock to fixed asset, right, you have to reclassify and you have to use market value. So value, when you say the first value 100 ringgit, Jess Lee, I think that is not relevant anymore. It is the market value that is relevant. So if the market value is 150, then you have to transfer it at 150. So what's the double entry? Simple. Your stock is 150, is worth 150. The selling price is supposed to be 150. So you have to credit your sale 150. You have a sale, credit a sale 150. But then because it goes to a fixed asset, you debit your fixed asset. You debit your fixed asset 150, right? So it's a credit sale, debit your fixed asset 150 because this goes into your fixed asset already. All right, I hope I get you, Jess. Okay, Yuan Xiang asked if we give the stock for free to a customer as sample, do we need to treat it as sale? No need. Well, sample is not, okay, put it this way, Yuan Xiang, if this is a real sample, right, it is not supposed to be something, I mean, a sample is not something that you usually sell, right? It's not something that you should usually sell. So if you have treated it as sample, that is not something that you usually sell. You don't have to treat it as sale, right? You don't have to. But of course, you need to expense off. You need to record what are the samples that has been given out. Then only you have a sample expenses. So what I would suggest you to do is, whenever you give out samples, right, debit an expense in your P&L to say sample, right, or promotion expenses, then you credit your stock. You credit your stock, reduce your stock, right? So you debit your expense in P&L, credit your stock, so that you recognize that some of the stocks has been expensed off as a sample. Okay, Yuan Xiang, I hope I get you. Yeah. Okay, let's, there is some more flashing. Let me see. Oh, Irene asking, please repeat. Wait, Yuan Xiang is further asking, if that is the real stock which we normally for sale? Well, like I said, I mean, if it's a real stock, I would suggest you don't just give like the exact same thing, if it's possible. But if you say, well, this is something that I really need to give it out, okay? Example, use the double entry that I was saying. You debit a sample expense, that means a promotional expense in your P&L, credit your stock. That would actually make it this is a real sample that you have expense of. And if in terms of value, what is the value? Again, like what I said, you use the market value or the cost, right? Whichever is lower. Okay. So Irene say, please repeat the transfer of stock to fixed asset. Okay. So this one, Irene, Jess Lee was asking, if you could see her question. Yeah. Jess was asking that if she's going to transfer the stock, right, to fixed asset, right? Value of the stock was 100, maybe the cost, but the market value is 150. What is the double entry? So the double entry is simple. You will have to credit your sale at 150, because over here it says reclassification. You need to use market value, right? You credit your sales at 150, then you debit your fixed asset at 150, right? That is what it means by you sell your stock back to yourself. You buy the stock, but now it becomes your fixed asset. So you use your market value. Okay. All right, so let's carry on. Next public ruling. Now, this is something important. Why? This is affecting a lot of people, actually. A lot of people in these recent years were actually telling us, right, especially if we do your tax, right, you probably would have been always talking to my managers, right, saying, hey, why do you need to tax me? I have not even rendered my service, right? Now, this public ruling talks about if you receive any sum, any money that you receive, or if there's any debt that you owe someone in respect of services to be rendered. Let me repeat that. This is to be rendered. That means you have not rendered the service. You have not even rendered the service. It's something that you will do in future, right? What is the tax treatment if you have already received money in advance, all right? So we got to go back to history. Before 2016, this is not a problem, because before 2016, right, you would say, hey, if I have not made a sale, right, if I have not actually rendered a service, this is not a sale. If this is not a sale, there is no income and I don't have to pay tax, even though I receive money in advance, right? Give one example. Let's say if you have to receive membership fees, right? I charge you a 5-year membership fee in advance, but I say, hey, the membership is only effective year by year, but I take something in advance, right? So every year when the membership takes effect, then only I recognize it as sale. Then only I will put it into my income and pay tax. Yeah, that was before 2016. You can do that. From 2016 onwards, rules change, right? The Income Tax Act has changed. Section 24 has changed, right? Later I'll show you the section, yeah? It has changed to say that if you receive money in advance, even though you have not rendered the service, you still have to pay tax first. You still have to pay tax because you have received the money. And that is why you see, previously, paragraph 24 say, any debt owing to a person in respect of any services rendered, right? Services rendered, yeah? It is treated as gross income. But from 2016 onwards, right, this section 24 has been changed, right? It changed to what? It's now paragraph 24, 1b, right, says, provide a debt owing to a person, right, and subsection 24, bracket 1, capital A, also say any sum received by a person, right, arises in respect of services to be rendered, not even rendered, to be rendered in future, will be treated as gross income. That means, if in any event you have to owe someone money, right? Or someone gives you money in advance, right? If you don't have to owe someone money, someone gives you money in advance for a service to be rendered in future, this is to be treated as gross income already. So now you may say, hey, I have not done my sale. This is just advance payment. But the Income Tax Act has changed, right? Section 24 has changed, right, since 2016. and now even you receive money in advance, or you have to owe someone money, right, for a service to be rendered in future, this is considered as your gross income. So what do you mean by that owing to a person in respect to any services rendered? Very simple, right? So it says a debt would arises when liability to pay exists, right? When you have a liability that you need to pay someone, that means you are owing someone money already, and it will be treated as gross income. And the other thing is, if you receive money, right, like the membership fee that I was saying, if someone pays you 5-year membership fee, right, you cannot say, oh, I will treat it as income year by year. Slowly, I recognize as income year by year. Cannot. The moment he pays you 5-year membership fee, that is your income in the year you receive it, even though you have not even though all the membership years has not been effective yet, right? So this sum is to be treated as gross income, right? Notwithstanding if there's any liability to pay or not, right? So that is the new treatment. Right. So what happens right now in from year 2016 onwards is that you look at this example, yeah, Galaxy Central Berhad, right, call it GSB provides office cleaning, right, office cleaning services, right, and closes its account annually on 31st December. In 2018, right, 1st of October, an agreement was signed, right, with a customer, Lavender Central Berhad. Now, according to the agreement, Lavender is required to make annual payment, right, annual payment for 90,000 in advance, on the agreed date for services to be rendered for a period of 3 years, that is from 2019 to 2021. So let's look at how it works. See, the service, right, the service is actually here. 2019, 1st January to 31st December. 2020 also the same, 1st January to 31st December. 2021 also the same, 1st January to 31st December. So what we usually would say is, okay, logically, you would say, hey, if the service is for 2019, 2020, and 2021, then the 90,000 that I received, that the GSB has received, I should relate it back to the period of service, right? If my period of service is 2019, the 90,000, the first 90,000 I received is my income for 2019. This is for 2020. This is for 2021. Now, this is before 2016. Yes, you may say so. But from 2016 onwards, you cannot say so. Why? Because this GSB, Galaxy Central Berhad, received the money in advance. Galaxy Central Berhad received all the money in December, the year before the service is being rendered. You see, Galaxy received this in 2018 December, received this in 2019 December, 2020 December. So now from 2016 onwards, when Galaxy received this in 2018, even though the service is for 2019, this is a 2018's income. This one is a 2019's income, and this is 2020's income. This is what we mean by if you receive something in advance, even though the service is to be rendered in future, you have to pay tax. It has to be your income in the year you receive it. So see, if we continue, the treatment here is the first 90,000, which is received in 2018, even though you say this is for a period of service in 2019, taxable income relates to 2018, not 2019. Remember that, right? Same goes to this one. The 90,000 goes to 2019, and this 90,000 also goes to 2020. See that? So this is according to the new paragraph 24(1)(b), which was amended with effect from year of assessment 2016. All right. Now, but what is worse here is, now look at this next example, If we say same fact, right? Same fact as example 1. But now, on this 13th of December 2019, LSB, Lavender, make advance payment of 116,000 instead of 90,000. Now, over here, right, this one, supposedly Lavender is supposed to pay 90,000 only, right? But Lavender went on and paid 116,000, even more than what he is supposed to pay in advance, right? He was supposed to pay 90, but he pays 116. Now, that means there's 26,000 extra, right? This 26,000 was supposed to actually pay in the next year, supposed to pay here, right? But he went and pay in 2019. So this 26,000 was supposed to be due and payable on the 15th December, has been paid in 2019, right? Has been paid earlier. What happened now? What happened now? Okay, see, if you ask, okay, whether there is a liability to pay or not, there is no liability to pay the 26,000, right? 90,000, yes, because 90,000 has to be paid on the 13th of December according to the contract, because the contract says you need to pay in advance. So the liability to pay has arises, right, for 90,000 only, 90,000 only. So according to paragraph 24(1)(b), the liability to pay has arisen, and it is supposed to be a taxable or gross income for 2019, right? So this one is clear because just according to the previous example, this is what it is. But the 26,000, there is no liability. You know, LSB does not have to pay the 26,000. It's just that he paid extra. He paid extra, right? And this was supposed to be due only in 2020, you know. But even though there is no liability, but paragraph 24, 1 capital A says what? Let's go backwards. Paragraph 24 sub 1 capital A, any sum received by a relevant person in respect of any services to be rendered, even though there's no liability to be paid, this is still be treated as gross income. This is still to be treated as gross income. Therefore, if Lavender has paid 116 instead of 90,000, this GSB, Galaxy Cinema Hut, has to take in the whole 116 as its gross income in year 2019. In year 2019, not year 2020. All right. So this is the effect of the amendment to Section 24. Right. Section 24 sub 1B and also 24 sub 1 capital A. Okay. So very simple. So it now says prior to 2016. Now, if you say, hey, so this is since 2016, right? What if I receive money in advance and I receive that money before 2016, and this advance payment that was received before 2016, it is actually for some service that will be rendered after 2016. Hey, so does it mean I have to change my whole accounting treatment? Now the good thing here is, if you receive any payment, advance payment prior to 2016, before even the introduction of this new subsection 24, 1 capital A, tax treatment prior to 2016 would be maintained. Right? What do you mean? Look at this example, yeah. High Securities and Remember Hut, right? It's a renowned security company. In 2015, now this is even before 2016, right? It receives advance payment of 72,000 for 6 years of services. This 6 years is from 2015 to 2020. Now, if it's according to the current treatment, right, this 72,000 will have to be taxed straight away, right, once you receive, right? But because this was received before 2016, right, it was received in 2015, right, this 12,000, right, is actually the service for each year, because there are 6 years. 6 times 12,000 is 72,000, right? So 12,000 will be treated as income in 2015, and then every year thereafter, right, he can still take in only 12,000 each year, right? So you see, this company sought a confirmation in respect of tax treatment from 2016 to 2020 for the balance of payment. Do I have to straight away take this 60,000 in already? No need, because the advance payment was received before 2016. You still only recognize 12,000 each year, right? From 2016 to 2020 onwards. You don't have to use that advance payment being taxed. The fact is because you receive it before 2016. Now, but anything after 2016, you have to be taxed right away, straight away. Okay, so you may also ask this question. You say, hey, not fair. This is not fair. You know, sometimes when I receive money in advance, all right, it doesn't mean I definitely can keep the money on, you know. I probably have to refund, right? Because it's advance payment, but like the membership fee. Let's say if I paid 5-year membership, after 2 years, I said, I do want to be your member already. The 3 years membership fee, right, please refund back to me, right? And I have to pay back the refund. Then what happened? Okay, I have got taxed already, you know. So it's a fair game. It's a fair game. Pursuant to Section 34, sub 7, capital A, right? This is a new, this is the amendment resulting from that Section 24 amendment. Section 34 of the Income Tax Act now says, if you have to refund your advance payment, if this advance payment has been taxed, all right, you have to refund it as long as it has been taxed. It has been treated as gross income in accordance to Section 24, sub 1, capital A. The year where you refund, right, you can claim deduction, right? You can claim deduction on the sum refunded in the basis period where the refund is made. So it's a fair game. If you have been taxed earlier and now in this year you have to refund, the year you refund it, right, it becomes your deduction, right? It becomes deduction, okay? So, but there are also certain amount that you receive in advance, all right? It's not taxable, okay? What could this, when would this happen, right? If you are in these industries. Now, if you are doing property development or construction, right? You have a separate income tax rule governing how to recognize your income. Now, those who are in construction line or business development, or sorry, property development, you will know that, to recognize your income, we don't just look at, your sale, your invoice, right? We have to look at the percentage of completion and things like that, right? So if you are being governed by another separate income tax rule, then yes, even though you receive money in advance, right, that is not taxable, because we will still go back to this income tax rule to look at, say, percentage of completion, how much have you completed, and recognize the income accordingly. So you will not be subject to this advance payment tax, okay? Or if you say you are a non-resident of which your income is under section 4 capital A, right, all this withholding tax, right, that is also not applicable. So if you pay advance payment to a non-resident, right, that non-resident doesn't have to pay tax immediately, because he is supposed to pay tax as per section 4 capital A. But of course, if you know, the moment you give money to your non-resident, right, you got to withhold his withholding tax also lah, right? But it's just that the income recognition is not as per the section 24 anymore if this person is a non-resident of which the tax is under section 4 capital A. Okay, or now some people will tell me this, hey, what about this, what if this is a deposit? If this is a deposit, this is not even an advance payment. It is a security deposit and it's refundable, right? Say if I have to rent out a machine, right? I have to take a deposit from them, right? When this machine is returned to me, and if it's without damages, then I have to return this deposit to them, right? If this is not an advance payment, this is not even, right, relating to your future services, it's not even going to be part of your sale, it is just a deposit, right, that of which upon completion of the service, this will be refunded, such as security deposit. This is not going to fall under this section 24 and becomes a taxable income. Likewise, deposits who are forfeitable. Say you say, I need to take your deposit because I need you to comply and adhere, right, to certain terms, right, certain terms and conditions of the agreement. If you don't follow the terms of the agreement, I will forfeit your deposit, right? If this is the kind of deposit that you are taking, then of course you don't have to pay tax the moment you receive. But remember, once it is forfeited, it becomes a taxable income. Right? It becomes a taxable income under paragraph 4A, right? Section 4A, business income. Okay, so that is practically what you need to understand about this advance payment. Okay, so let me look at the chat over here. I know there are some questions. Okay, Irene, wait, Irene is still asking about transfer of stock. Yeah? Okay, so Irene asked them, transfer of stock to fixed asset. Our current entry, debit FA, credit stock. Reason, purchase item was intended for FA, not meant for resale. So Irene, so your stock initially went into your stock, okay? And now you transfer it out and becomes your fixed asset. Now, if you do this, if you do your entry here, you debit fixed asset credit stock, you would have used the cost. You would have used the cost instead of market value. Unless you tell me the market value and the cost is the same, then, well, this is okay. This is okay. But if you tell me this market value and the cost is different, then if you look at the public ruling says otherwise. When you need to transfer it to your fixed asset, you use market value and not your cost, right? Not your cost, you use market value. Okay, if you say it was intended for fixed asset, not even meant for resale, then why did you put in stock? If you put it in stock, that means your initial intention was to resell. You see, now it's a bit contradicting. If you say your initial intention was not even for resale, why did you put it in stock at first stage? You should have just put it into your fixed asset, right? So Irene, you gotta really take care of this part. Now, Jess Lee asked, how about we pay advance payment? Can recognize as expense? No, answer is simple, no, Jess Lee. This advance payment, right, it's only recognized as income if you receive it in advance, right? Because that is the charging section. Section 24 talks about gross income. The expense part is section 33, right? Whether it is deductible or not. That one doesn't say if you make advance payment you can get deduction, right? It has to be a firm incurred expense, not even not an advance expense. It's an incurred expense obligated to pay, right? Then only you can get deduction. All right, Jess, I hope I get you. Yeah. Vivian say the advance received did not follow the tax treatment 2016. Then how? What do you mean? Advance receive? Oh, that means you receive advance, but you didn't follow the tax treatment from 2016 onwards. What happened? Wow, Vivian, that means you have reported your tax wrongly, right? Simple. You reported your tax wrongly. So if you ask me, then how? If you want to do it the most correct way, I will, of course, advise you do a revision. Do a revision of tax computation, right? Pay back the tax that you're supposed to pay. Of course, there will be penalty. Let me remind you, there will be penalty. But doing it now, the penalty is lower than being discovered by the Inland Revenue Board in future. Yeah, Vivian. Okay, next, what? Mega Fortress asks that the advance payment received is just need to pay tax early, not forward to recognize revenue early, right? Yes, that's correct, right? You may, in accounting, you may not recognize it as income, right? You may probably still account it as a prepayment received, or deposit received. Some people use this term, yeah? It is for you to recognize your income for income tax purpose. It doesn't mean you have to put it back as sale in your profit and loss account, right? So sometimes you may see tax agents seeing you have prepayment received, and we say we need to pick this up and put it as part of your income, right? Even though it's not part of your sale. Okay, so it means that we need to create a schedule to monitor which payment received already pay tax when we recognize revenue in account. Then we need to reduce tax payable revenue because we have already paid tax before. That's correct, Mega Fortress Lee. This is what we usually do. If you have got, let's say, a prepayment received of which tax agent has taken out and recognized it as income, next year, what we usually do is we will just ask you, see, this prepayment received, right, in last year's account, has it become sale already? Has it become a sale this year? If it has already become sale this year, then we will take out the sale amount from this year's sale and we don't tax it anymore because we don't want to double tax it. But if you tell me, oh, it has not become sale, it's still lying in the prepayment, then we will not take it out, right? And we know that the prepayment is still there, right? Until the moment it becomes sale, we will reduce your sale and we will not double tax it. Okay, Mega Patrice, I hope I get you. Ong Fui Kwan, deposit to kickstart the project for next year. Is it deposit considered as income as well? You got to explain further, yeah, Ong Fui Kwan, when you say deposit to kickstart the project, yeah. Is this deposit one of these or not? If your deposit is either one of these, that means it's a security deposit or it's a deposit for someone to adhere to certain terms and conditions and it will be refundable upon completion, then it will not be taxable. But if you say this deposit is something like an advance payment, right? An advance payment to kickstart, then yes, it has to be taxable because it's an advance payment. Very simple, right? It is a payment for future service. Okay, so when you ask, can you defer the income? Of course, answer is no lah, because the moment you receive the deposit, all right, in advance, which is an advance payment, you have to pay tax the year you receive it. Okay, so Mavis asks, Uncle Kwan is Mavis now. So you say, if I pay tax early, how do we deduct? Like I explained to Mega Fortress Lee just now, yeah. If you do that, if you recognize your income earlier, what you need to do is the moment it turns into sale, we don't take in the sale as a taxable income anymore. We have to reduce it by the amount that we have already recognized in the previous year, right? So it's a fair game. It's a fair game. Okay, Grace asks, what about down payment for construction project? Grace, you forgot what I said. If you are in a property development or construction line, right, there's another separate income tax rule that governs the income recognition. So you don't worry about the advance payment to be taxed, right? Because if you are doing construction, right, construction is something that they will recognize using a separate income tax rule based on the percentage of completion. Okay, Grace. Jack, we are manufacturer, usually receive 30% deposit upon placement of PO by customer. Production may take few months and delivery in the next year, meaning we need to pay tax for this deposit or we complete current tax submission. Now, Jack, if you're a manufacturer, you are selling goods. Remember, if you're doing manufacturing, you're selling goods. This section 24 is for services. It's for services to be rendered. Okay, so if you are not selling services, you're selling goods. What is very important here is just that if you say you receive money from your customer for selling of goods, and you have confirmed the transfer of risk of the goods to someone. Remember just now when we talked about the valuation of stock, we said when do we consider as transfer of goods, right? When you have confirmed the risk has been transferred over, right? It's confirmed a sale, then you recognize it as income, right? Because goods, if you receive anything in advance, right, for certain goods to be delivered in future but not delivered yet, right, that means the risk has not been transferred yet, you don't apply section 24. This is only for services to be rendered. Goods are not using this one, right? So LJAC, if you're a manufacturer, I don't think you would have to look at this because this is for services. Okay, so before we go to the next public ruling, let's take a short break as usual. It's 4:13 right now, so let's take a 10 minutes break. So we'll come back at 4:23. I know, Grace, you still have another question. Let me address that question later, right, when we come back, okay? Let's go for a short break. 4:23, we will resume. And again, remember, don't leave your computer. I mean, don't leave Zoom. Don't leave Zoom, right? You can leave your computer, but keep your computer here. Don't leave Zoom, because otherwise you have to come back again. So let's go for a short 10-minute break. We'll resume sharp at 4:23. Hong, I'll pass back to you in case if you want to put on some music. Hong? Okay, I hope everyone is back after a short 10 minutes break. You know what? I still see a lot of participants' name. Like I do not know whether this was like I have a 998-6551-7562. Who is this person? No, I mean, if you can just rename yourself, yeah. I mean, you probably know, hey, is it my name? Is this? Just look at the participants list. You can just click the participants, right? And you will see the top name, the very first name at the top. Once you click the participants, right? That is you. Your name is always the first one after you have clicked participants, right? So kindly Mr. or Miss 998-6551-7562, you can change your name, all right, so that we know who you are, all right? And I still see some name like Wintan. I still see Wintan, and I think YYC 172. I think this is our colleague. YYCians, please change your name, and put YYC at the end. Don't just put YYC 172. All right, so that at least we know who we are seeing is a real person, not just something like a bot or what. Okay, anyway, just now I've seen a question before we took a break. That's from Grace. Grace asked second time, so what about the down payment for construction project? Now, Grace, I think, okay, I believe you're trying to say that if you are doing construction project, right, if you are a contractor, you're doing construction and you receive down payment, would it be subject to paragraph 24(1)(b)? Now, like I mentioned earlier, if I could just share back my screen, let me just go back and share my screen. Where is my share button? Okay, let me share, click this and share. Okay, if I go back and share my screen, if you remember just how I was saying about this, I said, if you are actually subject to these separate income tax rules, say for example construction contract, then your services are not subject to this paragraph 24(1)(b), right? So if you say you receive a down payment for a construction, right, construction project, so if you are actually subject to these income tax rules already, which is the percentage of completion method and things like that, then don't bother about the advance payment. Don't bother about the 24(1)(b), all right? But unless you say, oh, my construction is a very, very short-term one, where it doesn't really, it doesn't even use this separate income tax rules, right? I would just treat my income tax as the usual service. Then yes, whatever they pay you in advance is taxable, subject to this 24(1)(b). Okay, so Grace, I hope that answers to your question, yeah? Okay, so I hope everyone is back already. So before I continue, can I again have a show of hand who is back? Give me the emoji, like, or clap, all right? Give me that reaction so that I know that you are back, so that I know everyone is back and I can continue speaking. Now, give me. Asta is giving me clap. Thank you, Asta. Who else? Yup, Nihon Denke. And I have YGH from EN Labor, Sim, and MN, Mega Fortress, and where are the rest? Vivian. Okay, Vivian giving me clap. Catherine, Lee Fong Lee, Muhammad. Okay, Rich Management. Okay, so I hope you guys are back, right? Not just leaving the computer, right, and walk away. Yeah. So let's carry on. And yes, I see the thing flashing again. Let me see what's happening in the chat. I think someone. Okay, back. Yes, cool. So Sutasan, yes. Kate Leong also clap. Okay, that is a good way to tell me that you're clapping. Okay, so good. C from ISO is asking this question. Then my invoice date in 2019 December for services January to March, and payment only received in February. Is it falling under section paragraph 24 in 2019? Okay, good question. See, if you already invoiced it in 2019, What does it mean? Go back to this one, yeah. You have already got a liability to pay, isn't it? I mean, your client has got a liability to pay, isn't it? The moment you issue invoice to your client, you are telling your client, look, I'm giving you invoice, you have to pay me. Unless you say, this is not really an invoice yet, this is a pro forma, you don't have to pay me yet, then different topic. But if you give an invoice, that's a liability already. When there's a liability to pay, a debt owing already, paragraph 24 1B arises, kicks in, right? That means you have to recognize the income already in year 2019, right? You were saying, yep, okay. So paragraph 24 1B says if there is a liability to pay already. 24 bracket 1 capital A talks about if you receive payment in advance, right? Even though there's no liability, but you have already received money in advance. Okay, so C from ISO standard Berhad. I hope you get what I mean. Okay, next public ruling. Okay, next one, we don't talk about public ruling already. We talk about practice note. Okay, the first practice note is practice note number 2. It's talking about claiming capital allowance on customized, there's a typo, sorry, it's computer, not computer, all right? Computer software under Income Tax Act. So this is simple, This is a practice note to just further explain to you that if you actually customize your own software, right? You actually develop your own computer software and it's a customized one. You didn't buy the software off the shelf, right? You could still claim capital allowance, right? This was actually amended 2 years ago, right? I think 2 or 3 years ago, yeah? So you see, development costs for customized software refers to what, right? If you have to develop your own software, right? Or in the improvement of an existing software for business purpose, you can claim capital allowance, right? And this is with effect from 2018. Yes, right? It was 2 years ago, yeah? 2 years ago, it was effective already in 2018. Because previously, prior to 2018, software is only given capital allowance if you buy a ready-made software, buy a software off the shelf. If you have to customize it on your own, you don't get to claim any capital allowance, even though you have to pay a lot of consultation fee, licensing fee, you don't get to claim capital allowance. But from 2018 onwards, you get to claim. And this is further confirmed via a PU order, right? An income tax rules has been gazetted, right, in 2019, and then reconfirmed that yes, if you develop your own software, you can claim capital allowance. So what is claimable? Because when you develop software, right, it's not as simple as I just pay a price and I get a software. Because you need to pay a lot of things, something like consultation fee. You see, if you have to pay consultation fee to develop a software, the consultation fee can be capitalized and you can claim capital allowance. But yeah, consultation fee only includes developing, modification, and modernization of software. If you have to pay consultation on the initial stage, right, at the initial stage for initial procedure or planning stage like feasibility study or preliminary study, these are not claimable, right? These are not claimable, right? So you can only claim if it's for developing, right? That means the development fee, yes, but the initial consultation just to see whether can I do software or not, whether it is feasible or not, this feasibility study cannot claim, right? I mean, you can capitalize it, but you still cannot claim capital allowance, yeah? So just to understand, you cannot claim. Now, any other incidental fee, say to enable the use of the software in the business, say installation fee, for example, where you need someone to install and there's an installation fee, let's say, that is also claimable, right? And of course, the rights of ownership, software ownership. If to use the software, right, to use this customized software, you need to pay some license fee, right? You need to pay for the rights to use the software. This is also capitalized and claimable for capital allowance. All right, so these are the things that you can claim capital allowance and is explained in this practice note. Okay, however, bear in mind that if you are getting a non-resident, if you're getting a foreigner, a non-resident to help you to develop software, please always be mindful with the withholding tax, okay? Withholding tax, because if you pay for the use of software, right, it could be royalty. Now, I think you know where the royalty definition has been amended to say that any payment for the rights to use software or payment for the usage of software is called royalty, and there could be withholding tax under section 109. But sometimes you see in the process of developing software, what I'm paying may not be for the rights to use software or for the usage of software yet, right? It is for certain other services, some other technical services, right, to be rendered, right, that falls under Section 4 capital A. Now, if that's the case, then it falls under Section 109B. 109B withholding tax talks about if this service is rendered in Malaysia, then yes, subject to withholding tax, but if it's rendered overseas, no withholding tax, right? So it is all depending on the facts, right? We have to look at whether this payment is really for the use of software or is it for some other service that falls under Section 4 capital A, because the withholding tax section will be different, okay? Now, if I say you can claim capital allowance on whatever that you have paid earlier, right, on developing of software, the capital allowance rate is 20/20, right? 20% initial allowance, 20% annual allowance, right? 20% initial allowance, 20% annual allowance, right? So that means first year you get 40%, next year 20%. So in 4 years' time, you get to claim everything, okay? All right, I see another question coming in. Vivian asks, if service provider outside Malaysia charge us SST, oh, you mean the service provider charge you the service tax, the what you call it, digital service tax, I suppose, yeah, because you say service provider is outside Malaysia. If you say they charge you SST, it should be the what you call it, the digital service tax. So you ask whether withholding tax still need to pay or not. Of course, you still need to pay if withholding tax is applicable. Always remember, many people ask me this question already, right? Again and again, they ask me, if I have to pay SST, do I still have to pay withholding tax? Remember, SST and withholding tax are totally different things, right? SST is under the Sales Tax Act or Service Tax Act, okay? Withholding tax is under Income Tax Act, right? Different act governed by different people also. One is by customs, another one is by Inland Revenue Board. So you cannot say because you have to pay service tax, therefore you don't pay withholding tax, okay? All right, thanks, Vivian. All right, yeah, don't call me Sifu, don't call me Sifu. I'm just sharing my my knowledge, and I know a lot of people have been asking me that. Okay, now next one, practice note number 3, 2020. This is very important. I must stress again, this is very, very important because this may affect your business. This may affect your tax, okay? This practice note number 3 talks about how to determine the 50 million gross income from business source, right? It talks about that. But what is really explained in practice note is like this. First, okay, we know that in year 2020 onwards, from YA2 to 2020 onwards, to qualify for the preferential tax rate, the 17% tax rate for the first 600,000 chargeable income, there are now 2 rules, you know. First rule is you say the paid up capital. The paid up capital must not be more than 2.5 million, right? And then there's one more rule. The second rule says you must have gross income from business not exceeding 50 million as well, right? Not exceeding 50 million ringgit, then only you can qualify for the 17% tax rate, right? This is applicable to both company as well as limited liability partnership, LLP, yeah? And this gross income is actually according to sections 22, 24, or 30 or to determine what is called gross business income. Actually, don't have to really bother about these sections because this is very technical. I'm just telling you, gross business income would mean your sales, to make it simple, your sales, right? Or anything that actually tax under Section 4A, right, of the Income Tax Act, right? Usually sales, okay? That is your gross business income. Of course, if you say you have other business income, that's also business income, yeah? So now, SME status with effect from year 2020, yeah, it says, as a company, you must be a company resident in Malaysia, resident and incorporated in Malaysia, okay? Paid up capital, not more than 2.5 million ringgit, all right? And then this is added from year 2020 onwards. This is added, they say gross business income, right? From source or sources consisting of business, not exceeding 50 million. Same goes to LLP. LLP must be resident in Malaysia. The contribution of capital is not more than 2.5 million. And the gross business income, right, does not exceed 50 million for one basis period, okay? So this is what I was explaining. But what is important here is that now, the preferential tax rate says, yeah, first 600,000, you get to pay 17%, right? If you qualify the SME status. Anything that exceeds this 600,000 chargeable income, you pay 24%, right? And also, as an SME, if you qualify the 2 conditions, if you fulfill both conditions, yeah, your special allowance, right? Or I wouldn't call it special allowance, I call it accelerated capital allowance, right? Or what we call as, yeah, I know the term used is special allowances, but actually it's in the form of accelerated capital allowance. For small value asset, you get to claim 100% capital allowance for small value asset. That means asset that does not exceed 2,000 ringgit each, and there's no limit. That means even though I have, let's say, one item is 2,000. Let's say I have 100 items, 2,000 ringgit each. The total value is 2,000 times 100 is 200,000, right? I can claim all 200,000. 100% capital allowance, right? There's no limit for me because I qualify as SME. But once I don't qualify as SME, I have a limit of 20,000 only. That means that even though I have bought 100 units of the 2,000 ringgit item, I can only claim how many? 2,000, 10 items, right? 10 items, that means that's 20,000 already. So 10 items, I claim 100% capital allowance, and then the balance of 180,000, I have to use the usual rate already, 20, 10, I can have to use the usual, I cannot get 100% already, okay? So SME has no limit, non-SME would have the 20,000 limit. Now, what is important here is this one. This practice note number 3, 2020 says, if you are an investment holding company, okay, what is investment holding company, right? Make things easy. Investment holding company means your income comes largely from investment income, like rental income, interest income, dividend income, right? Investment income. That means at least 80% of your income comes from investment income. You're called an investment holding company, right? An investment holding company not listed in Bursa, not listed in the stock market, will be governed under Section 60F of the Income Tax Act. This kind of company, I know if you own one, you have been always paying the lower tax rate, right? 17%, right? Practice note number 3 now says, this company, if they are called investment holding company, they are deemed to have no gross income from business source. If you have no gross income from business source, you don't qualify as SME. When you don't qualify for SME, you don't get the preferential tax treatment. That means you don't get these two. You don't get this one, you don't get this one. Of course, this one is not so relevant for investment holding company because investment holding has no capital allowance anyway. But you don't get the 17%, you pay only 24%. So if I were to make it very simple, if you are having an investment holding company, earns only rental income, let's say, you don't pay tax at 17%, you pay tax at 24%. Let me repeat, if you have a company that only earns rental income, you don't pay tax at 17%, you pay tax at 24% from year 2020 onwards. All right, so same goes to other companies. Like if you, let's say if you have an investment holding company listed on Bursa, right, that's Section 60FA. Now this one is a little bit different because an investment holding company listed on the stock market on Bursa, the income is deemed as gross business income, right? It's not like the non-listed investment holding, right? So as long as you have business income and it does not exceed 50 million, then yes, you can still use 17%, right? But if you say I have a company but does not have gross income from business, only have other incomes like rent, interest, including temporary closed business operations, that means you don't have business income anymore, you only have your other income, These income are not assessed as income under Section 4A of the Income Tax Act, therefore does not fulfill the criteria of SME, no preferential tax treatment. Means you still pay 24%, no 17% for you, right? Well, if you say I have income from overseas sources, would that be considered as business income? Yes, any gross income from foreign business source shall still be taken as having gross business income, right? As long as it's not exceeding 50 million, you would have the preferential tax treatment. Even if you have other incentives like pioneer status, investment tax allowance, it's okay. All exempted gross income from business source will still be taken in as gross business income. As long as it does not exceed 50 million, you still get the preferential tax rate. All right. So I see questions coming in already. Let me address this first. Yeah. All right. Eric Sanramberhat, right? Yvonne Paul says, if company is part of an MNC, does the company fall under SME status? Okay, Yvonne, I think if you say MNC, you probably, because you were confused with the definition of SME under the SME Corp, right? But the SME that we talk about here is the tax definition for SME. So no matter whether it's MNC or not, to know whether this company falls under SME status or not, you need to look at first whether this company has business income exceeding 50 million ringgit or not. If it exceeds, not SME anymore. Does not exceed, then you fulfill the first one. Second criteria, paid up capital. The paid up capital of this company, does it exceed 2.5 million? If it doesn't exceed, then okay. But if it exceeds, then sorry, cannot. Okay. Yeah. So and also Yvonne, if it is part of an MNC, you also have to look at the holding and subsidiary, right? The parent company and subsidiary company. Because if the parent company or the subsidiary company has paid up capital more than 2.5 million ringgit, then automatically this subsidiary is not an SME anymore. Okay, so that is what you need to look at, yeah, Yvonne. Okay, Dorothy asks, if has gain on trading of shares and rental income taxable as 17 or 24. Now, Dorothy, if you say you have trading of shares, if you treat the trading income from shares as business income, then yes, you have business income, right? If you have business income and if it does not exceed 50 million ringgit, and of course, if your paid up capital also does not exceed 2.5 million, then you still get the preferential tax rate of 17%, yeah? So you have to see whether your trading of shares is business or non-business. Most people would say they invest in shares. If they invest in shares, the investment income from shares like dividend, that is investment income. That is not trading income, not business income anymore, right? So it really depends on whether your share is business income or not. Your rental is definitely should not be business income unless you say your rental also business income Then what I want to say is that if you don't have business income, 24%, no more 17%. Okay. Jun Lee from K-Link asks, what if business income exceed 50 million? Still in SME criteria? No. Jun Lee, one of the conditions here to be SME is, all right, your company must have gross business income not exceeding, right? Not exceeding 50 million for one business period. So if you have more than 50 million ringgit, right, in sales, that is not SME anymore. So no 70% for you as well, 24%. Mavis asks, may I know when can we get the SME cert which certify the company SME company? Okay, offhand I cannot remember the web address. Okay, but if I'm not wrong, it's at SME Corp's website. If I'm not wrong, yeah. You can probably just Google, right? Go to SME Corp, right? I think that is in SME Corp. You can get the SME cert, but this SME cert is only useful for that reduction in rental and for reduction in rental, not for this purpose. This purpose, we don't use the SME cert at all. Okay, maybe, right? So since you asked, I just tell you that you want to get the SME cert, go to SME's Corp website. You'll be able to find that. Okay, so no questions, No questions, then I'll just carry on, yeah? I know it's a bad news, right? Especially if you hold an investment holding company, but that is how it is. Okay, that is how it is right now, yeah? Okay, next, service tax policy. Simple update from service tax policy. Now, this service tax policy number 9 was issued, right? Was issued earlier, but now there's an amendment, and this amendment is actually a good amendment. Why? Because this service tax policy number 9 talks about exemption of service tax, right, by accommodation premises operator. Okay, if you remember, right, when this service tax policy number 9 was issued, it says an accommodation premises operator like hotel operator, they don't have to charge you service tax on accommodation or any other related services under Group A, under accommodation. So for example, if this hotel also runs a laundry service, also runs a restaurant, right, that means a hotel runs a restaurant, they don't charge you service tax anymore. Yeah. So previously, it was only until 31st August, right? It was supposed to be from 1st of March until 31st August. Now, because of the Penjana announcement, the short-term economic recovery plan, this has been extended, right? So it's extended all the way to 30th June 2021, right? So for this, all of us, if you go and stay in a hotel in Malaysia, you'll find yourself not needing to pay service tax, right? As long as it is operated by the accommodation premises operator, right? Until 30th June 2021. Tourism tax was usually previously, as said, should be still charged, not exempted. But because of the Penjana announcement, it's now also amended to say tourism tax is also exempted. Okay, but of course, this is for foreigners. To us, we don't pay tourism tax, yeah? And it's exempted until 30th June 2021 as well, right? And of course, exempted services which occur on the 31st August and end on 1st September, the services shall be exempted from service tax. This was the previous one, right? The previous one. Now, it's extended, right? It says that for exempt services occurring on 30th June and ending on 1st July, all the services is exempted from service tax as well, right? So this one is talking about all the exempted services, right, that happen, right, on this day. You see here, initially it ends on the 31st August, right? It says from this date, all right, and end on 1st September, right, that shall be exempted because it says if it happened during the exemption period, but the service is only happening after exemption period, right, this will still be exempted. But because the due date has been extended, you see the due date has been extended to 30th June, so therefore this paragraph has to be amended to say whatever exam services that happen on 30th June but ending on the 1st July, it's still exempted, right? It's just to shift the final date, right, for the last day, right, for the last day of exemption. Okay, last thing. Oh yeah, I think I need to go back to the first public ruling, right? Yeah, okay. So let's look at GST refund first. So GST refund, there's some updates over here. In case if you still say, I still have GST refund with the government, right? Of which I have not actually got back. You know, what is there any update on this? Good news for you. If you still have some GST refund at the with the government of which you have not actually got back, yeah, there is this thing right now. There is a notice issued, right, by the customs and say goods and services tax, right, GST will be expedited, right, will be expedited beginning June 22nd, which is already over, yeah. So that means now they are taking this pay first, audit later approach, right? They want to pay you back first, right, before they audit, because previously they said they want to audit first before they can pay you back the refund. So now they change it, they say, I will pay you first, I'll come and audit later, okay? So if in case your refund is less than 100,000, good news for you, good news, right? As long as it passes the desk review verification, right? They don't really have to go in and audit. As long as they pass the desk review verification, they pay you back first. They pay you back all the GST refund first, right? Then if needed, they come and audit. But if your refund is more than 100,000, then you have to go through another process, right? Apart from this desk review verification, it still have to go through another process called the risk rating process. Okay, if you also pass this risk rating process, right, I mean you pass both risk rating and desk review process, then GST will be paid back to you in full first, right? They will come and audit later, but they pay you first, right? That is if it's more than 100,000. However, if the refund is more than 100,000 and does not pass the risk rating process, then this is where you don't get back your refund in full. You only get 90% first. You get a 90%, but it doesn't mean you won't get the last 10%. Yeah. So how to get the last 10%? You see, to get back the full GST refund, it has to go through a field audit. It has to go through a field audit being conducted by the RMCD, by the Royal Malaysian Customs, right? But if you say, okay, I do not want that to happen, I do not want this 10% to be withheld, I still want to get back in full first, you can do one thing. If it's more than 100,000, it passes the desk review verification process, but it doesn't pass the risk rating process. Yeah, what you can do is you can actually declare. Right? You can actually declare that the information given is correct and you agree to pay all the underpayment of GST penalty, and this is very important, you need to provide a bank guarantee, right? You provide a bank guarantee. That means you need to get a bank to say, right, to buy a bank guarantee, put it this way, from the bank, right, to say that if in case the refund is wrong, the customs can claim your bank guarantee, right? Can claim your bank guarantee, and your bank guarantee has to be 10% of the total GST refund amount. Right? You only have to get a 10% guarantee. You don't have to guarantee the whole full amount, just a 10%. Once you have this, right, then you get back a full refund. You get back your full refund because you already have a guarantee placed with customs. In case the customs says that, hey, the refund is wrong, then even you don't pay, he claims from your bank because you have already got a bank guarantee. Okay, so this is what you can do. Okay, so let's go back to the very first public ruling, of which I say I want to put it at the very last. That's with regards to tax incentives for bio-and-access status company. Now, I know probably none of you here has a bio-and-access status company, but if you do, right, we'll just quickly cover this one. We'll just go through this one quickly. But before that, let me just look at the chat, yeah? Let me just answer to some questions first, yeah? Mavis asks, may I know where can I get, okay, I already answered to this. Okay, wait, which certified developer company, not develop housing anymore. Okay, developer company, but not develop housing anymore. Okay, currently business income majority come from rental, so the company will not entitle for SME tax benefit 70% anymore. Now, Mavis, back to what I was saying. If you say this is a developer company, but not doing developing housing anymore, that means you probably has ceased the business income. So if you say you have ceased your business income and your income comes from rental, if the rental is not business income, let's say if the rental is not business income, it's only a Section 4D income, other income, then you're right, this company will not enjoy 17% anymore, right? But if you say this company is a developer, but only currently there's no project. Currently no project, yeah. And because of no project, this rental, yeah, some of the developers companies unit, when they rent out, if it's some unsold unit, they treat it as business income, you know. That means you still have business income, all right? So if you still have business income, then no worries, you can still get 17%. Unless you say all these are not under business income, then I can't help you. Then you have to pay 24%. Okay. Dorothy says ST exemption on FMB2 from consumer point of view. Dorothy, just now, I think probably you're talking about the accommodation premises operator. Now, put it this way, yeah, if it's normal FMB, there is no service tax exemption, okay? But if you go to a hotel and the restaurant is run by the hotel, right? Run by the hotel, that means the hotel is an accommodation premises operator. The hotel gets the exemption to not charge service tax. Therefore, the restaurant also will not be subject to service tax anymore. Okay, so if you go to the restaurant and the restaurant, let's say even though in the hotel, it's run by some other operators and this operator is not the hotel, you still have to pay service tax because the restaurant is not run by the hotel. Okay. All right, Vivian says it's not here, but I just saw new custom announcement regards information technology services. Any idea what is new? Vivian, okay, that's something that I have not seen myself also, but maybe next month we will have this, right? So I can't answer this yet because I have also not seen regarding the information technology services. But well, if it's something that we will update you, we will put it in next month's update class. All right, Vivian. So stay tuned with us for next month. Mavis asks further. Yes, it's an unsold unit just because no development for current moment and we still doing maintenance for all the rented developer units. Okay, so Mavis, if it's an unsold unit, the developer when rent out all these units, right, it will be treated as business income. So if it's treated as business income, then good, you still get 17% because you still have business income, right? As long as it does not exceed 50 million ringgit, that is very important, yeah. Okay, Mavis. Okay, so now let's go back to topic ruling number 1, tax incentive for bio-nexus status company. Now, before I even go into what's the tax incentive, let me just tell you what is bio-nexus status company, right? If you do this kind of qualifying activity, industrial biotechnology, healthcare biotechnology, or agriculture biotechnology, if you do this, then you are doing qualifying activity. Now, if you're doing this kind of qualifying activity, you actually can apply for bio-nexus status and you will get tax incentive, right? You can actually submit your application to Bioeconomic Corporation, right? And you will get a tax exemption incentive, right? Of course, subject to the approval of the Ministry of Finance. Okay, so what is your tax exemption that you will get, right? Pretty simple. For your non-intellectual property incentives, all right? So if you have non-IP, non-IP income, for a bio-nexus status company, what you will get is, you will get tax exemption for your statutory income, or 100% allowance, right, to be deducted against your statutory income for any qualifying capital expenditure incurred. Okay, so you still get a further exemption, right? If you say, right, you have been approved, right? You have been approved. You have a further tax exemption on your statutory income for your qualifying biotechnology activity, even after exemption YA's mention has ended, right? So just now it gives you this what you call it, exemption, right? And it's for a specific number of YAs only, in accordance to these orders, right? So different orders will give you different number of years. But if you say it has ended, right, you will still get a further exemption for up to 10 years, right? For up to 10 years, right? As long as you still, right, you still do qualifying biotechnology activity. Okay, and apart from that, you also get industrial building allowance. This is not a normal industrial building allowance. You get a 10% every year for your industrial building, as long as it is used for the qualifying activities. Now, what are the qualifying activities again? Let me just quickly go back. This one, industrial biotechnology, healthcare biotechnology, agricultural biotechnology. Okay, and on your statutory income, all right, if you are new, right, you say, I have not done all this biotechnology thing before, right, I set up a new business. If I set up a new business, or you expand your project of an approved bio-nexus status company, you also get 10 consecutive years statutory income exemption. But if it's an expansion, you get 5 years. So a new business get 10 years, expansion get 5 years exemption. but you must fulfill substantial requirement, right? In different types of qualifying activities has different types of requirements, right? And these requirements always linger around, yeah? How many number of full-time employees you have, right? What is your annual operating expenditure? And whether you have invested enough, right? An adequate investment for fixed asset in Malaysia. You must fulfill all these, right? Then only you can get your exemption, all right? And of course, all these numbers, right, differs depending on what kind of activities you are doing. All right. Now, but if you say, hey, I have got my buyer access before, right? And I have got my substantial requirement previously. But now this new rules come out, right? This new PU order came out, and now I could not fulfill the new requirements. What happened now, right? You can do the grandfathering rules. Now, what is grandfathering rules? That means you fulfill the previous requirements, but you can't fulfill the new requirements. Now, if you say, I have been granted BioNexus status before 16th of October 2017, right? You can have that BioNexus status with you all the way until this one, until 1st of July. But from 1st of July, you must actually follow the new rules already, right? To continue enjoying the exemption, you must follow the new rules. Otherwise, it ends, right? The grandfathering rules would end. If you say, I have a new qualifying activity after 16th of October, and I've been granted, right, this exemption up to 31st December 2018, then yes, your exemption is until here only, right? From 1st January onwards, you have to follow the new rules. Same goes with this one. Anything that's granted after 16th of October 2017, your exemption would end if you cannot follow the substantial requirement from 1st January 2019 onwards. Okay, but remember, just like I was saying, non-IP, you get those exemptions. But what if you get IP income, royalty income, intellectual property income? Now, all these you don't get exemption, right? This is to be excluded from the scope of exemption, yeah, right? So if you get royalties or IP, you don't get this exemption, right? You don't get this exemption, yeah. And this is with effect from 1st of July 2018. Okay. All right. Then, of course, date of commencement of the exclusion of IP, right, is effective from 1st of July, okay, from the exempted statutory income of the BioNexus status company. So remember, IP income would not qualify for tax exemption and will still be subject to tax. Okay, and of course you get capital allowance as well, right? You get capital allowance like your industrial building allowance and capital allowance. So it says, well, you still get a capital allowance, no problem, right? And any amount of unabsorbed capital allowance can be carried forward into the future, right? Until it is fully utilized. So no worries about that. Okay, and your industrial building allowance, just like I mentioned to you, you get a 10% rate every year, all right? This will be deemed as incurred on the date of commencement of the business or project. Okay, so CA or IBA, of which you dispose of the your asset within 2 years, you will get a clawback. All the CA or IBA given will be clawback. Just normal rules, capital allowance. You can't sell any of your assets of which you have claimed capital allowance within 2 years. Within 2 years, you sell them, all the capital allowance will be clawback. That means it is as if you have not claimed capital allowance. Okay, so on losses, also the same. Right, any losses before the exam, right, year of assessment commences, right, can be carried forward, right, can be carried forward even after the exam period ends, and it will be deducted from your statutory income. Okay, and deduction for promotion of exports, also the same, right? If you have any promotion of export, okay, and your revenue expenditure under Section 33 in relation to the promotion of export, right, is eligible for deduction, and the additional deduction can also be accumulated until after the exam period. You know, just like a normal pioneer status, when you have all your revenue expenditure incurred during your exemption period, right? Just like your pioneer status, yeah, you can actually accumulate all this, all right, and use it and utilize it after the exemption period ends. Okay, so that is how it works. Of course, if you incur on R&D, right, R&D, research and development expenditure, right, that is approved under Section 34, capital A, you can still get double deduction, right, and shall be claimed in the year of assessment it was incurred, right? But if you are on a BioNexus status company, all of these deduction for R&D can be accumulated until after exam period ends, then only you get the deduction for your R&D expenditure. Okay, so that is briefly about BioNexus, right? Of course, if you are really having BioNexus company, then yep, you probably want to come to us to understand more, right? Because I know a lot of you may not be bio-on-access company, so I just want to quickly cover that. Okay, so let me just go to Q&A now. Okay, it's 5:02, so I still have time for Q&A. All right, so I still have 70 over of you. So let me just answer to some questions first, yeah. Mavis asks, yeah, apart from it, how is withholding tax work? Foreigner given consultation from overseas via email for our business in Malaysia and charge us consultation. Do we need to pay withholding tax? Okay, you're saying a foreigner gives you consultation from overseas. So he's overseas, you're in Malaysia, he gives you consultation and charge you consultation fee. Do you have to pay withholding tax? Now, if this consultation, right, is falling under section 4 capital A, that means withholding tax, right, would be under 109B, section 109B. And section 109B says what? If this service is done in Malaysia, only there will be withholding tax. If it is done overseas, there will not be withholding tax, right? So I assume if this consultation is done overseas, that this person doesn't even come into Malaysia, no withholding tax should apply, yeah? So if this consultation is regarding those technical consultancy, things like that, okay? Vivian asks, is this applicable to those skincare product technology, manufacturing biotechnology? Okay, Vivian, you're talking about the biotech skincare product. Well, now BioNexus company over here talks about biotechnology. You know, that means you have to do research on biotechnology, right? And you either develop it for industrial use, or for healthcare use, or for agriculture use. So you're saying skincare product. Now, skincare product, unless you say this skincare product is to be used in industrial, then, well, probably you can look into that. What I would suggest you is, Vivian, if you say you are really venturing into this, why don't you, make an appointment with us? So let us really look into what you are really doing and see if it, falls into this bio-on-access status or not. If it falls into, then good news for you, you get a lot of exemption, right, Vivian? Okay, Mavis asks further, yeah, and then can we help the supplier to pay for the withholding tax without minus the payment we pay to them? Wait, Mavis, just now I mentioned there is no withholding tax, but when you say withholding tax, then why you have to help them to pay withholding tax without minus the payment? Mavis, is this something from your previous question? Because the previous question say, is there any withholding tax? Oh, you said if have. Oh, if there is withholding tax, you mean? Okay, if there is withholding tax, can we help supplier to pay for the withholding tax without minus the payment we pay to them? Oh, okay, if there is withholding tax, and you want to pay on your own without minusing the payment, of course you can. Of course you can do so. But like I always say, if you do so, the withholding tax amount that you pay on behalf of them without minusing, right? You pay extra right now, right? That withholding tax amount is not tax deductible one. Please remember that is non-tax deductible, yeah, because it's not something that you should pay extra on your own. It's something that you have to deduct. Okay, all right. Okay, Vivian then say how to calculate 20,000 tax allowance or rebate for new business incorporated for 3 years. Vivian, this is something regarding the Benjana one, right? This is something new. Okay, of course, there are some rules over there, of which you have to be an SME, you have to register your company with SME Corp, right? And then only you can get this tax allowance, right? If I remember correctly, it says that you first you have to be an SME, then you have to get approval, right, from SME Corp. Then if you fulfills the conditions, right, the conditions stated by SME Corp, you will get actually a deduction, right, given to you for every year for the next 3 years, right, if you start up a new SME. So this is according to that Benjana thing, right, the short-term economic recovery plan, right? So I think if you really want to understand further about that, I would suggest, all right, if you go to SME Corp, you will see all the conditions stated therein on how to qualify for this. Okay, so is there any other questions from your side? Right, let me see if there's any other questions. I think there's no more question. Looks like everyone get this very well. Okay, if there's no question, I'll pass this back to Hong then. All right, I'll just say thank you to everyone.